Hi, it's Joni Michaels, and it's my pleasure to introduce you to Joe Clark, host of Consider This Program. Joe's a certified financial planner and former professor at Purdue University. He's the managing partner for the Financial Enhancement Group. Joe's passion is teaching people about their money so they don't make inefficient financial decisions that lead to frustration and devastation. The Financial Enhancement Group serves more than 900 families in 31 states and manages more than $400 million. The Financial Enhancement Group takes care of people who don't want to worry about their money so they don't make inefficient financial decisions. Joe addresses your questions about money in 5 critical elements of finance: retirement planning, or what we like to call your life after work, tax planning, investment planning, life happens, the good, the bad, and the ugly of life, and legacy planning. The Financial Enhancement Group can be reached at 800-928-4001 or visit yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA, SIPC.
Well, good morning and welcome to Consider This. I'm your host, Joe Clark.
And I'm Angie Kinzer.
Happy to have you along, and happy middle of June. Hard to believe. Amazing how quick a year can go, even when you've been stuck at home. Angie.
Yes. I actually came across my favorite thing, polls, and it was from a blog called The Senior Planet. And anyway, it had a big picture of, you remember from Seinfeld, George Costanza's dad, Frank Costanza? Well,
I'll pretend and say yes.
Okay, most people do know Seinfeld.
I would give you that.
So anyway, he was always real grumpy, and he was always like, "Let the grievances begin," and then it'd be list after list. So they had a little play on that, and they had his picture, "Let the grievances begin," and it was the top 5. They polled 1,000 people for the top 5.
Now you said this is from a seniors magazine. So what makes a senior? Just out of curiosity.
Over 55.
Oh, so we're not quite there.
No,
we're almost.
Almost.
You know, my mother asked at 73 or 4 and change if she was a senior when down in Florida, and I said, "Well, Mom, in the rest of the country, yes, you're a senior. In Florida, probably not."
No, she's a youngster there.
All right, what do we have?
Okay, these are the top 5 pandemic pet peeves. So I'm going to start with 5 so that we can go upwards. Line jumpers at the grocery store was number 5, but number 4 makes more sense. People handling fruits and vegetables at the store without gloves. That was number 4. Number 3, busybodies who are snitches who call other people out. Number 2, no haircuts.
Well, I can get that. I very much can get that.
And the number 1 pet peeve was wearing a mask for an extended period of time.
That they had to, or that they were?
That they had to.
Yeah.
I mean, I don't stay anywhere too long that I have to wear a mask the whole time because it is hard.
It is hard, and I'm a big boy.
So
and my ears pop out like Dumbo, and the masks will not stay on my face. I had to have one. The only one that's worked is one that was specially made that apparently is not as effective as it would be. So it's I have to hold it up to my mouth when I walk through. I can't strap it onto my ears. But such is life. Line cutters, they do bother me too. I get it. You and I've even talked about the zipper strategy on the highway.
Oh,
Remember that on the way back from a thing?
Oh, yeah.
Hey, welcome to Consider This program. We are going to have a lot of fun today. Get into a little bit of diversification with international investing, a few other topics. We hope you're enjoying that the world is being opened back up. Still stay safe, and welcome to the program and enjoy it. We'll be right back.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider This program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, yourlifeafterwork.com. Now let's get back to the show.
Hey, the last decade, the only place to be from an investment standpoint is the S&P 500. Being in the U.S. market, international markets have suffered. China, over a 10-year period of time, was actually negative, Angie. And so a lot of people really don't understand international investing. They're taught in school and told in places that you need to have it for diversification. And historically, that has been true. Things may be changing. It may be going back that direction. But for the last decade, not so much. Today, we're going to talk about international investing and some of the additional risks that you take and things that you may want to consider. Welcome to Consider This program. I'm your host, Joe Clark.
And I'm Angie Kinzer.
Happy to have you along. We get these questions every now and then, me probably more so than Angie on this, but she has compiled questions for me nonetheless. So I'm ready to roll.
Always keeping my questions. What, as far as foreign, the risk with that, what are the two biggest risks with foreign investing?
The diversifying into an international world, one, you want to know what it is you own. People feel more comfortable. They're willing to accept more volatility. I remember one of our families coming in the mid-90s and said, now I'm very conservative. He had 70% of his money in Chrysler stock and 30% of his money in cash,
Okay.
right? To him, Chrysler wasn't a risk. He showed up every day to work in Newcastle. The plant was there. He could see what was going on. And that is a perception that people have. When you're more familiar with something, it's easier to withstand volatility. It's hard to understand foreign countries, foreign businesses,
Right.
unless they're actually traded here. So one, you have to deal with what we call political risk. You can think about what's going on with China right now. Some of the things with Germany, the tariffs, the trade wars, the things that go on inside of that, just the rules changing. Right, we get used to U.S. rules, what you can and you can't do, and then other countries may change the rules or allow that, especially when you get into the emerging markets, where you have regime changes that have happened, or countries flat out going bankruptcy. But the biggest risk inside that's not true of American companies. The biggest risk that you have inside of foreign investing is currency risk. And it's that fluctuation in the value of a currency. And it's not it's controlled by the larger institutions, but it really comes down to supply and demand. If people think that the United States is the safest bet on the planet, which they do, the value of the dollar goes up relative to the value of the euro or our neighbors to the north in Canada or the peso down in Mexico. They're things that you have to consider. So a few years ago, we had people who were calling and saying, why haven't we invested in Germany? It's up 30% year to date. And that's true, but the euro had gone down in value while the dollar had gone up in value, and the real net return was far less than what the S&P 500 earned. It was closer to 3% in U.S. dollar terms. So I've long argued the thing that most affluent families in the United States understand the least about their money is currency risk.
What about some of the other countries? I mean, sometimes I don't even think about that, and I know you'll mention them every once in a while at one of our Thirdly dinners, that Japan or what. That's not even on my list of questions. I'm curious, what are some other countries doing? Because sometimes we feel like we're doing terrible, but
we feel like we're doing terrible in what?
Like when we have volatility and things go down, we're like,
no.
oh, shoot.
Japan's stock market peaked in 1991. 1991. In Germany, the 5 most favored stocks have massively underperformed the market. Some are even negative. Volatility happens everywhere. The United States market has seen its share of volatility. My career has seen its share of volatility, but that has nothing to do with international investing. The international investing is understanding that there are other economies, right? China is now the second largest economy. Japan is the third. Most people wouldn't know that our largest trading partners to the north of us, it's Canada, it's not China. So the big thing, and you can get into that currency valuation, and I talked about it a little bit in the newspaper column that'll be out this weekend. And don't forget, you can go to our website at yourlifeafterwork.com to read that if you don't happen to get it in the Herald Bulletin. And we put it up on our Tidbits page, our Facebook group as well, Financial Tidbits. Get signed up for that if you would like. But when the value of your currency goes down, then if you are an importer, life becomes very challenging, right? So when the dollar goes down in value, people who buy stuff from other countries have a struggle. Suddenly the price went up, right? On the other hand, if your dollar is strong, right, you're a great importer, right? So people who export primarily want the value of their currency to go down. People who import want their value of their currency to go up, right? It's why you hear the president oftentimes say the dollar is overvalued, and we'll have people with lots of resources say the dollar is going to fall to zero. I heard it on a gold commercial. The currencies don't work like that. They are priced based on what other countries are willing to pay, and people have to have money in foreign currencies. We have money in foreign currencies, and in our car companies that work in China, work in the Euro region, that work in Japan. Because they can't afford the currency risk. And so the hedge is to own that currency. China does the same thing. They own dollars and they own U.S. treasuries.
That was one of our questions. What are hedging strategies?
There are, most individual investors have no business in the commodity space at all of doing that. We don't even buy the commodities themselves, the Financial Enhancement Group. But there are exchange-traded funds that are priced in other currencies that are out there. So the biggest point of this is it's, a lot of people who do this on their own, Angie, will look at the 3, 5, and 10-year track records. They're going to look to see foreign investments have done pathetic. I mean, horrid, right? And I don't want you to get caught into that mix. I don't tell people to diversify for diversification's sake. I will just tell you when we start to see the tides beginning to turn. As of the time of this taping, the S&P 500 is up over 19% for the quarter. Japan, Germany, and a few other countries in the Euro region are actually up even more so, right? Now, some would argue that's because they opened up their economy sooner and got back to work. But the big deal, in our opinion, is the amount of liquidity that's being put into the system. The CARES Act put over $3 trillion into the United States economy. You add on top of that, that the international world, Germany, the Euro region, if you'd asked me 24, 36 months ago, our wager would have been after the Brexit vote that Germany would essentially secede from the Euro region as well, right? They're after a $2.5 trillion bailout going into the Euro region. And when you see that kind of money being used, it pretty much partners Germany with Greece, with Italy, whether they want to be or not. And as a result, I think you're seeing some stability that's there now that wasn't there before that is changing part of that trade. Now, that's not me telling you to go out and buy any foreign country or anything else. It's just I want you to understand the concept of diversification. The United States is far and away the largest economy. It was before, is now, will be afterwards, right? But that doesn't mean it's the only economy. There's other places to be able to look at out there.
You touched on political risk. Can you purchase insurance for that?
If you can, I don't know. I mean, Lloyd's maybe would insure anything, but there are things you can do to try to hedge strategies in case that happens. But those are more for professional investors than what individuals are going to be able to do. Hey, folks, if you want to have your portfolio looked at, give Angie a call at 800-928-4001. Get signed up for your Next Steps meeting. We will sit down with you for 90 minutes, tell you things you want to consider today, things you may want to consider in the future, and if we choose to partner together, what FEG will do for you. Again, it's 800-928-4001. We'll be right back.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
Hey, if you've heard this show for a while, you know that I am not the greatest lover of annuities. And in all fairness, I'm not that big of a fan of commission-based products. That's a little bit different than annuities. And I've been challenged to say, is there ever a right time for an annuity? You're listening to Consider This Program. I am your host, Joe Clark.
I'm Angie Kinzer.
And, the basic question that I got, Angie, which kind of provoked this, and then you can ask your questions, is if other people say that they're okay and you say that they're not, what's the difference? What's going on with that?
Right.
And it all comes down to Jerry Maguire.
Okay. Show me the money.
Show me the money. That's the greatest line I've ever heard on a movie, probably, or at least one of them.
Yeah.
Show me the money. And there's the commission-based world frustrates me in terms of how people are lured into buying things that they don't necessarily understand. If you don't understand annuities, I will tell you, we had an engineer that put $1 million in an annuity for he and his wife each. And when my CFA, Adam Harder, took apart the prospectus, there's no higher financial title, by the way, as a money manager than a CFA, Chartered Financial Analyst. He's been doing it for 20 years. He's one of my partners. And he threw the thing down on my desk and he says, if a CFA can't tell you what they own, they have no business being able to buy it. And yet they did. And inside we found over $80,000 a year of hidden fees that they didn't even know they were paying. So yes, I have emotional issues with people who sell products to people who should not be making those decisions on their own.
So is that what load or no load?
Yes, load means there is a commission that's either paid upfront or a deferred sales charge. Deferred sales charge is when you pay a little bit more internally along the way, but you have a surrender charge. So if you get out of it early, you have a problem.
So are no load annuities better?
No loads are what we use when we have to use an annuity.
Okay.
And a no load is one that has no contractual period of time that you're stuck into it. It has no commission that's paid. So we're registered investment advisors. We get paid to treat your money as if it were our money and we were in the same situation. So we use annuities in 3 different ways. The largest majority, far and away, are people who already have an annuity product. They bought it from a commission-based thing, and the tax implication's too great. So we transfer it to a no-load annuity to save those 3, 4, 5% fees that are buried inside of some of those contracts. The second way we use them is when we have somebody who needs immediate income that is guaranteed for a certain period of time. Maybe they've got creditor issues or they've got challenges that are out there with their kids where regardless of what they have, they're going to give it to their kids. They don't eat, but their kids do. An annuity is a way to fix that when you annuitize income. The third then is in a QLAC, a Qualified Lifetime Annuity Contract that was just created a few years ago. We don't see them used very often, but they do exist and they are there.
So
But never a loaded annuity. We don't use any commission-based anything.
On the ones that are no load or without commission, do they offer minimum like guaranteed benefits?
Some of them can. Remember, anytime you have a guarantee anything, it's an insurance.
Okay.
And you're paying more fees. So it really depends on what it is you're trying to accomplish. I have seen fees in annuity contracts make sense in 1999. I've seen fees in insurance contracts issued in 2007 make sense. Other than that, I have not seen the fees used. People buy these lifetime rider where they get a guarantee of 5% on their income for years without understanding how complex and crazy that is, nor what they pay for it. And I have only seen one person in 32 years actually activate that rider.
Now, I do get a lot of folks call in and they might mention the fact that they have taken an annuity and they're like, and then we never heard another word from the people or the advisor.
Right. So when I started back in 1998 or 1997 with the Financial Enhancement Group, 1987 in my career, in 1997 it was $300 to make a stock trade. And so for somebody that had $50,000, $100,000, it actually made sense to buy an annuity as opposed to buying a brokerage account because of the cost of trading. But things change. I mean, we created the Roth IRA in 1998. There's all sorts of stuff changed. And now we have zero cost of trading. So the world has changed in terms of what's going on. So I don't hold people accountable for decisions that they made 20 years ago. It's just where we are today and things that you really need to you need to consider. But do understand things change.
It does make sense that if someone gets paid a commission up front, they really don't have a huge incentive.
And that's what I was going back to. I was not an RIA. I was not a fiduciary in '97 when we started the Financial Enhancement Group. We became fiduciaries in 2002. 2001, pardon me. I don't condemn anybody, but what happened back in 1997 is I had every intentions of coming back and seeing you next year. If you bought an annuity and I got paid a commission, I intended to be there next year to see you. The problem is if a new person called in, right, I had to go see the new person as opposed to take care of Angie because Angie's already paid me, right? And so there's what we would call a moral hazard in the insurance business. Here today, and sometimes it frustrates people, but we had a family call in today that wants to come in and see me, and I already told them we have 2 families that I'm obligated to see that we already take care of. I get paid every year for taking care of families as a fiduciary, and so our alignment is in sync. My first obligation is to take care of people that we've promised to take care of, and I will see new people as quickly as I can, which is why we always encourage you to call, get on the books, get signed up. Give Angie a call at 800-928-4001. We're getting into that period of time where people are asking questions. You got a lot of things that are going on this year with taxes being delayed. Get signed up for a Next Steps meeting. Give her a call at 800-928-4001. Now,
do you get to choose your asset allocation model?
It depends. So there's 3 different types of annuities primarily. There's a fixed annuity, which has got a guaranteed rate of return minimum, and then the insurance company tells you what you're going to get for the year. That's true of load and no load. There are equity indexed annuities, which I don't use, that are out there that gives you a percentage of what a particular stock market thing would use. And then the third one is the variable annuity, and the variable annuity is the one that has the different investment accounts that are in it. And yes, you get a pick. In our case, because we're the asset managers, we've got 40 or 50 choices that are inside of one of our variable annuities, and we go in and manage the money just like we do at a portfolio at TD Ameritrade.
Of course, we do have a checklist that we have made up.
And if you're thinking about buying an annuity,
yeah, you might need to look at that checklist. Actually,
not might.
You have to look at it. Actually, we have now our checklist on our homepage, and we have a button that takes you easy to the checklist that you need to download.
Yeah, and I would strongly encourage you to go to yourlifeafterwork.com. Putting in our website probably won't work. You might need to know the address. So it's yourlifeafterwork.com. Go to it and push that you want the checklist. But what I did was came up with a list of questions. If you're going to buy one, these are what you need to answer. And if the person who's trying to sell you one can't answer them, you probably shouldn't be buying it from them, right? I mean, there are issues inside of annuities that people fail to recognize. And one of the biggest ones is that tax deferral is a much better sounding thing on the front end that is on the rear end. And you need to be aware of that. But things that sound good for today may be good for today, but it doesn't mean it's good for your financial journey. That's really what you're on, guys, is a financial journey. This is not a one-time thing. We've got to make sure your money lasts as long as you do, hopefully even longer for your heirs and your charities, but last as long as you do. Give Angie a call, 800-928-4001. We look forward to seeing you very, very soon. Again, 800-928-4001. Get the checklist at yourlifeafterwork.com.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, yourlifeafterwork.com. Now let's get back to the show.
Target dated funds in the scheme of investments are relatively new things. Probably been around 10 years, maybe a little bit longer in some 401k plans. What shocks me is how little people really understand about the ins and outs of target dated funds. Welcome to Consider This Program. I'm your host, Joe Clark.
I'm Angie Kinzer.
And Angie's going to, is in charge of all things information and questions. So if you've got something that you want to hear on the show, you can always go to our website at yourlifeafterwork.com and submit a question, or call Angie at 800-928-4001.
Well, we had the question. Someone did ask, what is a target dated fund?
So here's the challenge inside of a mutual fund. We've got a guy who has got a pension plan, or not a pension plan, but a defined contribution plan for all intents and purposes, that retired from Purdue last year, that has not been changed essentially since the mid-'70s. When he started working, he put in his allocation. Now, it changed a few times because defined contribution plans were really created in 1980. But his allocation from 1981, the paperwork that he'd not changed all the way through.
Wow.
So over the last 40 years, stocks have done better than bonds, and the amount of money that when he started his initial allocation of 60-40 when he was 22 or 23 years old as a PhD, was the same allocation that he had when he retired. The difference is it was about 83% of his money was in equities, because things had changed. And secondly, his life had changed. He'd gone from having no kids and no money to having a family, raising the kids, getting them through school, and now he's at his retirement period of time with more money in equities than I have in my account, right? At 53 and still going on. And that happens to people, and it happens a lot. And so what a target dated fund is, in general, it lets you pick a date that you plan on retiring, and the further out you are until you retire, the more in equities you typically will have. And the closer you get to retirement, the more in fixed income and cash you will have. It's never zero. It's never 100% of one and 0% of another. But the percentages change as your life conditions change.
What is a through series?
So one of the things that confuses people, the difference in returns on target dated funds was dramatic in last year. I mean, some of the research is just phenomenal. So a through is through the year. So if your target dated fund was 2025, it's through 2025. If it's just target dated 2025, then it changes at the beginning of the year. And just little nuances that people don't look at to try to understand. I think the biggest point of that is not the difference between through and a beginning of the year, as much as it is understanding that fixed income, though deemed to be less volatile than equities over an extended period of time, that's not necessarily the case in a shorter term period of time. You always have to pay attention to the economy that's around you. That doesn't mean you make emotional decisions and be silly. You've got to have educated, disciplined process to be able to put into place. But that's why you hire fiduciaries.
How are they different from funds that start lowering equity allocation at retirement?
Essentially that is the same thing. They just use different names. There are some series that are called retirement series. More of those are in annuities than in the mutual fund environment, but they do exist. Same concept.
I'm going to guess that fear that was created by the pandemic did cause an increase in withdrawals. What's the normal withdrawal rate?
Well, it did create what we call so there's two different questions, and people confuse those words when they read about them. A typical withdrawal rate is what I'm taking out of accounts for people to be able to maintain their retirement. So here at the Financial Enhancement Group, the average amount of money that people take out is about 2% a year, but that's because there's some people who take none and some people who take 4%. So it really depends on what your income needs are, whether you have required minimum distributions, etc. Those are withdrawals. What you're talking about in that question are called outflows, and it's the amount of money moving out of a bond fund into stock funds, or out of stock funds into cash, or out of cash into bonds. It's watching that money flow, and it's something that we watch every week. And yes, when the market is at its low, by definition, you will have the largest outflows you've ever seen. The largest outflows we saw were in December of 2018. You may remember that was not a great month. Then we had some outflows that came out a little bit over the course of last year. In May was the next one, and those are the largest outflows you've seen in the May of 19, and that you'd seen since near October of 09, maybe a little bit more than October. Huge withdrawals, and we saw that happen in March and April of this year. So poor individual people who are selling with emotion, they're reacting, what we call the red R, as opposed to responding with the green R and making changes, got clobbered. And that's why some people like the notion of a target dated fund. Angie, everybody likes choices. Very few people like to make decisions. And so at the end of the day, we help reduce financial regrets. We get paid to make decisions. That is our job. But we do it for a lot of money. At the time of this taping, a little over $500 million for more than 1,000 families throughout the country. And we don't make the decision for Joe's money or Angie's money. We make the decision for all of the money, that is out there based on the models that you happen to be in, which forces us to follow disciplines and be a little bit more conservative than the average person doing it on their own.
You've used that quote a lot, and I just kind of, as far as people like to choices, but they don't like to make decisions. And, we have an annual family golf outing, and I've been making some phone calls and noticed that last year everyone was saying, well, is this what we're going to make for our craft? So this year I had 3 choices. And everyone was so happy to get the 3 choices. Now people are saying, we don't know what to pick. Just pick one for us.
Exactly.
So, yes.
And that is, it's I always say the Cheesecake Factory is the greatest example. It's got to be the most obscene menu I've ever sseen in my entire life. It's like an encyclopedia book. And I know that you youngsters don't even know what an encyclopedia is, but Google it. But you used to have these real thick books called a Britannica. And that's what the cheesecake menu looks like. And boy, it's just great to have all of those choices. It's just horrible to make the decision.
Yeah, ice cream stores.
What do you get? Ice cream stores.
Do you remember Bertie Owens?
I do. And what was the Baskin & Robbins had 31 choices.
Yes.
And what was the Barnum Brothers? No, it wasn't Barnum. That's a circus. There was one down in Indianapolis that we went to a couple times that was actually, just amazing stuff. But
Yes.
anyhow, we're off subject.
Okay, sorry about this.
This is what happens when you have 2 people on a diet.
Yeah, I know. We're dreaming of ice cream and cheesecake. Someone wanted to know, what the actual numbers for this quarter that you talked about, March and April, compared to, say, last year at the same time. How much difference is there?
When you got to March and April, the market was a little bit negative year over year. Well, by the time you got through May, it's a little bit ahead. So but it really depends on your allocation and your model and what you had and how much movement you made inside of your portfolio. I've told people today, if you went to sleep January 1st and you woke up today, you'd think it's been a pretty boring market year. Right? I mean, the NASDAQ made a new high intraday the day of this recording. It fell back, who knows where it'll end. But we're 2 or 3% off of the highs. It's kind of a dull, boring year, right? Hey, you're listening to Consider This Program. Give us a call, 800-928-4001. And don't forget to go to yourlifeafterwork.com.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This Program with Joe Clark.
The CARES Act came out March 27th. It was complex. It was full of opportunity out of crisis. Many people don't understand the choices that are there, what it really means. We're going to break it down for you on Consider This Program today. Welcome to Consider This Program. I'm your host, Joe Clark.
I am Angie Kinzer.
We are happy to have you along. For those of you who don't know, I'm the managing partner at the Financial Enhancement Group, a certified financial planner. We have 29 people on our team and our registered investment advisors. We function as fiduciaries with offices all over central Indiana. Getting ready to open up our office in Brownsburg, Indiana.
Yes.
Happy to add that to the equation. If you'd like to sit down and have a conversation, you can give Angie a call at 800-928-4001. All right, Angie.
Well, we've talked a lot about the CARES Act and different areas that it impacts. What relief has that act offered for distributions?
It has done several things. If you have a 401k plan, which you do,
Okay.
and I don't allow loans out of the 401k, but if you or somebody in your immediate family has been impacted by the virus, you have the ability to get out up to $100,000 of your 401k of what you're vested in. You have the ability to get that sent to you in a check. You have the ability to put that money back in over the next 3 years if you'd like to. So you're limited on the amount of money you can contribute into your 401k, but you can have access to that money right now. So if you've had an interrupted income, right? Let's say you're a high-paid salesperson and you've not been able to go out and work, and suddenly your taxable income this year is going to be a lot lower. It might be a good thing if you've been affected by the virus and you need to check to make sure that you are eligible. There's a checklist for that to make sure you're eligible for that distribution, but you can get money out of your 401k or IRAs without paying the 10% federal penalty. Obviously, that's for people under 59 and a half, Angie.
Okay.
Right? So you get to pay the money back in over 3 years and pay the taxes over 3 years. So it gives people cash flow right now, but reduces the burden of the tax penalty, the taxation today.
You mentioned earlier, you said, we have a 401k here. You don't allow loans. What if your plan doesn't allow for access?
They have to.
Okay, so
That's a federal mandate that came out of the CARES Act.
Okay, I didn't know who controlled that decision. If it's
that, and part of the confusion out of the CARES Act is you got so many chefs in the kitchen, right? You've got the Small Business Administration, you've got the United States Treasury, you've got the Department of Labor, you've got the IRS, and they're all kind of working on having their best, their control on the deal.
So, yeah, so they have to let you be able to have access to it, but do they have to allow for plan amendments?
Doesn't even require an amendment for this. An amendment is something that has to go in to change the way your plan document at work works on a permanent basis. In this case, it was as simple as filing a form. So I did it. I filed that form because I wanted to see how it looked with our plan, because I know specifically that our plan doesn't allow it.
Okay.
And I didn't take the money. I wanted to see what the form looked like and what it took to get it.
You said the limit on it was $100,000.
Well, that's the max.
The max.
100% of your vested up to that amount of money is what you're eligible to get out of a 401k or a 403b. In your IRA, you're vested for all of it.
I was going to ask you about eligibility and then say, do you have to prove that you were personally impacted?
You're going to have to testify to that, right? I mean, you're going to have to. It's self-certification. You're going to have to certify that. I can't imagine I'm asking everybody to come up with a medical receipt at some point in time to prove this. I just think it's too much overkill. But I mean, follow the rules. I mean, we don't do any. We would never encourage you at the Financial Enhancement Group to cross a line or to take a risk with something. I go up to what the rules allow, but we don't take one step into the wild yonder.
Okay, I didn't know if they broke it down into categories of like, these are the people who are eligible if this, or this happened.
The biggest part on the distribution is, did it impact did you or somebody else impacted by the COVID directly? And, and the answer for that for most people, did it interrupt your income? Did you get the disease or the virus, right?
I saw that one of them said, even if you were stuck at home because of lack of child care.
And that's one you could argue. I mean, did it impact your income? And the answer is yes, right? So
we've been really blessed here that we got to continue to work.
We have done our best to be able to keep you guys all employed. Everybody's still here on the team, and we've been able to buy the stuff that we needed to make so that you guys could all work remotely. But it's been challenging for us for some more than others. You and I have got as much work done, but you're not quite an empty nester, but you're close.
Yes.
I am an empty nester, so it's me and Barb and the dog. My biggest challenge is on Zoom with Othello barking, right? And
Yes.
and that has happened.
A couple of things that you've talked about actually kind of pre-corona was our in-service or hardship distributions.
So a hardship distribution is when you work for a company and you've got a 401k plan and you want to pull money out. They will usually let you, but it's fully taxable. They have to withhold 20%. There is a 10% federal penalty if you're under 59.5, and you're not eligible to contribute this year. That's a normal hardship distribution.
And those people probably aren't planning on paying it back in over.
If you took the distribution, you can't pay it back in.
Okay.
You can take out a loan if the plan allows.
Well, I'm talking about now they're saying.
Well, now with the CARES Act, we eliminated the 10% penalty. They eliminated the 20% automatic forced withholding. And you can pay it back over 3 years. But this is just for this period of time. And again,
Right.
you have to have been able to substantiate that you were impacted, by the virus. So, when I took out the form when I got the form in April, the market was down 25%, right? There's no way to say that our incomes weren't infected by it. And today, we've been very, very blessed. We have more families that we serve today than we did at the beginning of the year, and more assets that we manage than we did at the beginning of the year. So for me to say that my income has been impacted by the virus is not an accurate statement.
So the other one, in-service.
In-service is when you're working, typically when you're over 59. Some plans are over 50. They allow you to do an in-service non-hardship distribution where you can roll money out of the 401k into an IRA. And why would you want to do that? You wouldn't want to do it to buy a commissioned annuity. If you missed that, go back and listen to one of the earlier segments of this show. You wouldn't want to do that at all. But if you were looking for more investment options or wanting to work with a fiduciary that was outside of there, it makes sense in some cases to do the in-service non-hardship distribution. We've done a lot of them. We've helped a lot of people this year that have lost their jobs, that had 401ks, where companies said, hey, you can't come back. We're not rehiring. We had that happen with some of the people on our team spouses. They had jobs at big companies for 8-10 years and, just got, they weren't furloughed. They were laid off permanently, and they called it a restructure.
Oh, and I've had phone calls in from some of the radio show listeners saying, I'm not quite to retirement yet. I'm almost there. I'm not happy with how my 401k is doing, and there's absolutely no help with it and the choices are so limited within. So they might be a good candidate for something like that.
Yeah, you can call your HR department or we can help you, but if you're over 59.5 and you've got a substantial amount of money in your 401k, this is something you want to understand about. In-service, non-hardship distributions. Every single word counts. We are happy to help you with it. We do those on I don't want to say daily, but certainly a weekly basis throughout the team. Hey, you're listening to Consider This Program. Give us a call. Angie will take your call at 800-928-4001 or go to our website, yourlifeafterwork.com. Get signed up for a complimentary meeting. More than happy to sit down and discuss your options with you. 800-928-4001.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider This program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, yourlifeafterwork.com. Now let's get back to the show.
Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
I'm Angie Kinzer.
So we are talking about the CARES Act and interrupted income issues. We always want to take a crisis and turn it into an opportunity. You have your choice how you want to respond. You cannot control conditions that occur, but you can control your response. We're trying to give you the best insight that you can use. We've already done that on the show in case your income was interrupted and teaching you how to use your retirement assets. The next question, Angie, is in terms of charitable contributions.
Yeah, we've talked about QCDs a lot, and I had a question where it said, someone asked, with RMDs currently suspended, does it make sense to use a QCD?
So remember, a QCD is a qualified charitable distribution. So you had two acts that happened last year, Angie. You had the Secure Act that happened December 20th that changed the date of required minimum distributions from 70 and a half to 72.
Okay.
Right? Under a QCD, or a qualified charitable distribution, you still have the ability to do that at age 70 and a half so that charitable planning didn't get messed up. So you can still do a QCD. Now for 2020, because of the CARES Act, different than the Secure Act, the CARES Act from March 27th eliminated all required minimum distributions this year. Now that does not mean that you can't take money out of your IRA or 401k, and it certainly doesn't mean that you shouldn't take money. I mean, a lot of tax opportunities are going to be missed this year because people are going to go, hey, I don't have to take it this year. Well, folks, remember, rule number one, it's always about your standard of living first. Now, you may not need the money. I get that. But if you do need the money, certainly take it. The second part of that, though, is understanding the tax code. And that's where we get into bracket bumping and some of our other tax strategies. But in this case, let's stick to charitable gifting. You can still, if you gift money to a charities, and you have an IRA or you have an IRA. If you have a 401k, you've got to move it to the IRA first to be able to do the QCD. But you can still do a QCD up to $100,000 this year, and that's each. So if you're married and you each got to have qualified retirement money in an IRA, you can do that up to $100,000 to a 501c3 entity. There's some rules that go with QCDs. We've talked about that before. You can get our checklist, again, if you go to our website at yourlifeafterwork.com, and happy to provide a QCD, here's what you need to know checklist.
Is there anything different in 2020 for cash gifts to charities?
There is. Typically, when you look at your adjusted gross income on your tax return, you're able to give 30%, up to 30% of your adjusted gross income away every year, again, to 501c3s with appreciated assets. So that could be real estate, primarily stock is what happens there. You can give, after the change in 2017, you can give up to 60% of your adjusted gross income in cash. For 2020, because of what's happened, you can actually give away 100% of your income this year if you wanted to. So if I was going to do that, let's say I had $1 million in an IRA and I cared about my charity and I made $100,000 in income this year, I would consider giving away $100,000 of income to the charity. If you do a QCD, by the way, you don't get the deduction. So it doesn't reduce your income. You just never have to pay taxes on it, right? So I would consider using a maneuver that took care of my charities up to the top of the 12% bracket, pay income at the top of the 12% bracket. Anything above that, I would give away out of my income to charity. And if I had space between my income and my 12% bracket, I would probably use the QCD to get me to the top, to get money out of the IRA. Ideally, folks, you do not want to go into the 22% bracket if you do not have to, and certainly above. Now, if you're fortunate enough to have income, you may be stuck there. The old expression, don't complain if you're paying taxes if you're making money. That doesn't mean we don't want to make the most sense of our money, right? We want to create the right strategy for where we are.
You sometimes talk about above the line. So this question is, can you still claim the new above the line deduction if you itemize?
Actually, you can take the above the line if you itemize or if you don't, but it's only $300.
Right. Right.
What it is, above the line is above adjusted gross income, and now the majority of the population takes the standard deduction because they were raised effective January 1 of 18 in the Tax Act that passed in December of 2017. So most people take the standard deduction. You get $12,000 a year as a single person under 65, $13,300 if you're over 65, and if you're married, just double both of those numbers depending on your spouse's age. So in Barb and I's case, we have a $24,000 item or standard deduction. Most people don't go over that. Right? The big three in deductions are state taxes, which are now limited to $10,000, your mortgage interest, and most of the people that we take care of that are older have already got their mortgages paid off or near that, so their interest part's left. So that just leaves philanthropic. And sadly, most people don't give $24,000 a year to charitable causes. They don't have the resources or they don't give. So this ability to do that $300 is a special gift that you can put in. Above the line is typically more impactful than below the line. Okay. So the $300 is a good deal, especially for those of you taking the standard deduction.
We did have this question. What is double stacking, or what is that strategy?
Double stacking is the idea because the standard deduction is so high right now. And actually, I'm working on a triple stack. But it's the ability to pay everything that you have that you would itemize in 1 year, but pay 2 years in 1 year. So you go through let's just talk about you being a philanthropic giver, and you give away $15,000 a year, right? Plus you've got some state taxes. Well, you're still not going to be able to take the standard or itemize because the standard deduction is $24,000. Well, what if I gave my $15,000 to church this year, and in December I gave them a check for $15,000, but I told them it was for 2021. Now all of a sudden I've got $30,000 worth of itemized deductions that I can use in 2020. Mm-hmm. The charity or the church may need the money right now more than they need it next year. Who knows what next year holds, right? But they may need it more now. Now I've got enough to be able to take the itemized deduction and be able to do what needs to be, what I need to be able to do for my tax return and take advantage of that situation. It comes down to tax strategies, and you've got to be smart enough to be able to, I shouldn't say smart enough. You got to, be aware of how the tax code works. You've got to understand, more importantly, your financial vision, your intent of what you're trying to accomplish. And then we got to be able to look at your resources and say, okay, based on where we are, here's what we're able to accomplish and to get done. Right? Mm-hmm. And that's what the Financial Enhancement Group really helps people do. So if you call Angie at 800-928-4001 and say, hey, I want to sign up for my Next Steps meeting, Angie will get you signed up with one of our advisors, and in 90 minutes we will cover with the 5 critical elements: your life after work, annual tax planning, the investment playbook, life happens, and the legacy plan. We'll tell you what you need to consider right now, things you're going to want to consider in the future, and if we choose to partner together, what FEG will do for you. Again, give Angie a call, 800-928-4001. Have a great week, my friends. We'll see you soon.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
Well, good morning and welcome back to Consider This program. I'm your host, Joe Clark.
I'm Angie Kinzer.
Happy to have you along, Angie.
Thanks. Glad to be here.
Happy to have you along, too, as those listeners, whether it be on our podcast at Consider This Program, wherever you listen to podcasts, or whether it be right here on the radio. Happy to have you along.
Well, I was reading, and some of the home-based business ideas for people, and I thought I'm going to bring a couple
They
of them.
They are very much inspired during times of economic
Yes.
chaos.
Yes. So I thought I'm going to take down a couple of the top ones and see if it's something you would do.
Ah.
Because number one is guest lodging, meaning things like VRBO.
B&B.
Yes.
Those kind of
Airbnb.
things. Yes, I would.
Like if you were on vacation anyway.
I don't know about that, but if I was there, the B&B part, Barb and I used to do that when we rode the Harleys back, 20 years ago, and 15 years ago, I guess, and truly enjoyed staying at bed and breakfast.
Well, it says that, if you're in an area anyway that's like a major tourist city, that you could make so much money doing this. Remember when the Super Bowl was in Indianapolis?
Oh, yeah.
Even clear out to our areas, they were saying
yes, they were.
thousands of dollars a night.
But that's when you had to clear out of the house. I'm not sure I'm clearing out of the house to go to a hotel room to let somebody else use my house.
Well,
But it would depend on the amount of money.
Yes. Yes. The second thing is...
By the way, you can rent your house out for 14 days a year and not pay any income tax on it.
Oh, really?
Just saying.
The second thing is a mail order retail platform, meaning thinking of things like Pinterest, Etsy. If you had a product that you wanted to just sell out of your home, because Amazon's getting into that now.
No. That's why I've given you all this stuff in my storage shed and said, you go sell it on eBay. I don't want to figure out how it works. You can have the money, right? Go ahead.
Okay, this one I think you're going to say yes to.
Uh-oh.
Number 3 was life coaching, and that's working remotely. It says in that article, the older we get, we are increasingly drawn to the pursuits that serve and support others, according to psychologists. Would you make a career of giving away your secrets?
I would say I think we already do that in our life group and in some of the counseling we do with people in churches. There's a part of the Small Business Administration that helps young entrepreneurs figure out their business plans and make sure that they're doing. So I don't know if I would make my career out of it, though. That's
after you've retired.
Yeah, like I'm going to retire. I have no interest. I have lots of interest of doing that. I have no interest of retiring. So yes, I will. We regularly do that. I feel like I'm more of a counselor some days than a money manager, especially with people I've taken care of for 3 decades. It's how to deal with grandkids and the problems, not how to manage the money. They know we've got that down.
Yeah, I remember back at our old office, because I was kind of that way more on a personal level, I had the Lucy on my door that said advice 5 cents.
Yes, come on in, and boy, did she ever do it. Hey, folks, we truly enjoy you joining in the program, sending us your questions. You can get those to us off the website at yourlifeafterwork.com or give Angie a call at 800-928-4001. Folks, I am so glad the state is reopened, but please be safe out there. Be smart. Stay healthy. We look forward to seeing you again next week. Take care.
You've been listening to Consider This Program with Joe Clark. As a certified financial planner, former professor at Purdue University, and with 31 years of experience helping families just like you eliminate the fear and confusion of retirement, Joe's team has the answers to your questions. Go to yourlifeafterwork.com or call 800-928-4001 and find a time to meet with the Financial Enhancement Group. There's nothing that will separate you from your retirement as fast as the IRS. There are many questions that can be answered at the Financial Enhancement Group. Questions like when to take Social Security, how will my 401k be taxed? These questions are just the tip of the iceberg, and you need to be asking these questions now before it's too late. The Financial Enhancement Group has offices in Anderson, Fishers, and Lafayette, Indiana, but they also take care of families in 30 other states. You care about your retirement, you don't want to worry about your money? Then the Financial Enhancement Group is right for you. As fiduciaries, they are required by law to treat your money as if it were their own and they were in the same situation. Call 800